studying your last two. I swim med tea when they turned in. The styrene down to mute. And can lend a pole that sunk he died.
This slide highlights a lesson that every experienced tax advisor eventually learns. Even when you believe you have done everything correctly, the CRA may still ask questions. Many owner-managers assume that if they have maintained good records, filed their tax returns, signed the necessary agreements, and kept supporting documentation, there should be no issues. And while those steps are extremely important, they do not automatically prevent a CRA review. In the example shown on this slide, the owner-manager has all the things we would normally expect to see. There are receipts. There is a loan agreement. Corporate records have been maintained. Tax returns have been filed. At first glance, everything appears to be in order. From the taxpayer's perspective, the file may seem complete. The natural conclusion is that everything is fine. However, the CRA often approaches the situation differently. An auditor may review the same file and decide to take a closer look. That does not necessarily mean the taxpayer has done something wrong. It simply means that the CRA wants to understand the transaction more thoroughly. The auditor may ask questions about the purpose of the transaction. They may request additional supporting documents. They may want to understand how the transaction was carried out in practice. And they may compare the paperwork with the actual facts and circumstances. This surprises many taxpayers. They assume that once the forms are completed and the documents are signed, the issue is settled. But tax compliance and CRA acceptance are not always the same thing. The CRA has the authority to review transactions and determine whether the facts support the tax treatment being claimed. That is why a well-documented transaction can still be reviewed, and in some cases, it can even be challenged. The important point is that a CRA review does not automatically mean a reassessment will occur. Many reviews end with no changes at all. However, taxpayers should understand that proper documentation is only one part of the process. The CRA may still ask questions to verify that the transaction reflects what actually happened. The key takeaway from this slide is simple. Good records are essential. Loan agreements are important. Corporate documentation matters. But none of these things guarantee that the CRA will automatically agree with your position. Even well-documented transactions may be reviewed and challenged. That is why successful tax planning AA is not just about creating paperwork. It is about ensuring that the facts, the documentation, and the underlying business purpose all support the same conclusion. This slide introduces one of the most important concepts in tax audits and tax planning: substance over form. Many taxpayers believe that if the paperwork is complete, the transaction should automatically be accepted by the CRA. And while proper documentation is extremely important, it is only part of the analysis. Let's begin on the left side of the slide. From the taxpayer's perspective, everything appears to be in order. There is a signed loan agreement. Receipts have been retained. Journal entries have been recorded. Corporate minutes have been prepared. Looking at the file, the taxpayer sees a complete package of documentation. On the surface, everything looks correct. This is often where many taxpayers stop their analysis. However, the CRA approaches the file differently. The CRA certainly reviews the documentation, but the auditor is also trying to answer a deeper question. What actually happened? This is why the magnifying glass in the center of the slide is so important. The CRA looks through the paperwork and examines the reality of the transaction underneath. The documents represent the form of the transaction. The CRA is trying to determine the substance of the transaction. In other words, did the transaction operate in practice the way the documents suggest it operated? For example, a loan agreement may state that a shareholder loan must be repaid. But did repayment actually occur? Corporate minutes may authorize a transaction. But was the transaction carried out consistently with those minutes? Receipts may exist. But do they genuinely support the business purpose being claimed? These are the types of questions auditors often ask. That is why the right side of the slide focuses on what the CRA sees. The CRA examines the actual purpose of the transaction, the economic reality, the consistency of the taxpayer's actions, the supporting evidence, and ultimately, the substance of the transaction itself. This approach is often summarized by the phrase, substance over form. The CRA is not limited to looking at paperwork alone. Instead, the CRA evaluates whether the facts and circumstances support the tax treatment being claimed. Good documentation remains extremely important. In fact, strong documentation is often one of the best defenses available during an audit. But documentation by itself is not always enough. The documentation must align with the reality of what occurred. The facts must support the records. And the taxpayer's actions must support the position being taken. The key takeaway from this slide is simple. Good paperwork helps. But the CRA also evaluates whether the transaction reflects economic reality. That is why experienced tax advisors focus not only on creating proper documentation, but also on ensuring that the underlying facts support the intended tax result. Ultimately, the strongest tax position is one where both the paperwork and the reality tell the same story. This slide brings together one of the most valuable lessons in tax planning: the difference between technical compliance and audit-proof compliance. Many taxpayers focus on technical compliance. They make sure the forms are completed. They sign the necessary agreements. They meet filing deadlines. And they satisfy the minimum legal requirements. All of these things are important. In fact, they are the foundation of good tax compliance. However, meeting the technical requirements is not always enough to protect a position during a CRA audit. A transaction can be technically correct and still attract scrutiny if the surrounding facts do not support it. This is where audit-proof compliance becomes important. Audit-proof compliance begins with technical compliance, but it goes much further. It includes strong documentation, consistent behavior, a clear business purpose, supporting evidence, and the ability to explain exactly why the transaction occurred and how it was carried out. Think of it this way. Technical compliance asks, did you follow the rules? Audit-proof compliance asks, can you prove that the facts support your position? This distinction becomes very important during a CRA review. The auditor is not simply checking whether a form exists. The auditor is trying to determine whether the underlying facts support the tax treatment being claimed. That is why the center of the slide emphasizes an important idea. Good tax planning is not just about following the rules. It is about being able to defend the position if questions arise later. Let's look at the real-world examples shown at the bottom of the slide. In the weak position, there is a loan agreement. On paper, the taxpayer appears to have done the right thing. But when the auditor examines the facts, the evidence does not support what the agreement says. Perhaps repayments were never made. Perhaps the parties did not behave consistently with the agreement. Perhaps the business purpose is unclear. In that situation, the existence of the document alone may not be enough. The likelihood of a CRA challenge increases. Now compare that to the strong position. There is still a loan agreement, but this time the facts support it. The parties act consistently with the agreement. The records match the transactions. The documentation supports the business purpose. And the evidence aligns with the tax treatment being claimed. As a result, the taxpayer has a much stronger position if the CRA asks questions. This is the difference between simply having paperwork and having a defensible file. Experienced tax advisors understand that the strongest tax positions are built from both documentation and evidence. The paperwork tells the story. The facts prove the story. The key takeaway is simple. Good tax planning is not only about being right, it is about being able to prove you are right. When technical compliance is supported by strong evidence, consistent behavior, and a clear business purpose, the result is a much stronger position that is better equipped to withstand CRA scrutiny.